Welcome to the Stockscores Market Minutes for February 11th, 2013. This week's topic, trade from a strong foundation. I missed last week as I was ill, my apologies, but we're back to normal this week. Let's get into this week's topic. To begin, what do I mean by a strong foundation? When stocks are trading sideways with relatively low price volatility, they are building a base for the buyers or the sellers to launch off of. If you have a sideways trading range between, say, $9.50 and $10, and then one day the stock jumps up to $10.50, it's making a break from a strong price foundation. Now, these bases provide a floor for managing risk because it is at the bottom of those foundations that we can set our stop to control our risk. We want to look for stocks that are breaking out of strong bases. The closer to the base you can pick up these stocks, the lower the risk. Now, stocks that are strong but far from a base are risky and are often not worth buying, not because they're not good stocks, but simply because it's difficult to manage risk. Let me show you an example of a stock that I featured in my newsletter last week. This is a company listed on the New York Stock Exchange, symbol XIN. And you can see that I have highlighted in green a period of sideways trading where the stock was relatively boring. Now, this particular chart is an intraday 30-minute chart going back 15 days. And so for about 10 days, we had that sideways boring trading, but it formed a strong foundation. Now, on the 7th of January, the stock broke from that foundation and started its upward move. And that was when I picked up on the stock and not only bought it myself, but featured it in my newsletter with a live trade alert. Now, today the stock is still strong, but we are farther from that base and therefore the risk is greater. And to me, right now, it's not a stock that I'd want to buy, although it remains a hold. The reason I don't want to buy it here is it's too far from support at $3.70. It's too far from its foundation. It is a precarious stock. If the sellers find some motivation, they've got a long way to push that stock down until they get back to the foundation. If you had bought it on the 7th, well, you're relatively close to that foundation, and so the risk of a big loss is much less. All right, let's get into the analysis this week. Here is the chart of the S&P 500 ETF SPY, and you can see what we're all probably aware of. The buyers are in control of the market, although it is hard to call the market an exciting one. There's not a whole lot of trading opportunities right now. The market just kind of quietly is moving up day after day. Now, I've drawn in red a line of resistance across the tops going back into 2012, early 2012, and then the high set in September. And so we are rising up to that line of resistance. There's no sign of breakdown here, but given that the market's been pretty much going straight up since the middle of November, outside of the fiscal cliff issue at the end of December, I think that this market is overdue for some profit taking, and it may happen now that we are at that red line of resistance. With that said, no sign of weakness yet, just something you want to watch out for. Now, here's a chart of the TSX. You can see I've drawn the two longer green lines. The upper and lower one there is the upward sloping channel. And within that channel, we're in a pretty good little upward move that's been in place since the middle of November. We are a little bit of a breakdown, say, a week and a half ago, but not really a big deal. It didn't break that shorter term upward trend line. So the buyers are in control here again, but again, it just feels like there's a real lack of enthusiasm among the buyers. And it's probably because the market's been moving up for a while and the buyers are just trying hard to find some motivation and really can't. There's nothing that makes them want to chase after stocks, and so it's just this institutional buying that's coming in that is slowly making these markets move higher. The Russell 2000 is in a good upward trend as well, but again, it's been going up for over 3 months, and therefore we have to watch for a break of that upward trend line that I've drawn in green as a cue that there's going to be some profit taking. Now, that could happen tomorrow. That could happen in 6 months. We don't know when it's going to happen, and it's best not to anticipate a breakdown. For now, you got to stay bullish, but certainly have a very close eye on these index charts, because if they do break down, we should get a pretty quick pullback that can be traded, but you don't want to be long stocks when that happens. The TLT, which is the Treasury Bond ETF, is in a downward trend, and that's good for stocks. That means money is moving out of bonds and landing somewhere, and one of those places it's probably landing is the stock market. There is an abundance of cash out there. It's coming out of the bonds. It's coming courtesy of the U.S. Federal Reserve, and I think that's what's driving the upward trend in stocks. It's not really enthusiasm about companies. It's just a matter of there being all this money that has to be put to work, and it's being thrown into the market each day. The US dollar is in a bearish pattern, but it's actually had a pretty good run the last 4 or 5 days, and it's testing that downward trend line. So we could see the US dollar reverse its recent weakness, or at least that weak pattern. But until it happens, I wouldn't get too worried about it. If the US dollar does get a lot stronger, if we see this ETF move up through 22, 22.10, that would imply that the US dollar is getting stronger, which is actually negative for North American stocks, and we'd want to be watchful of that. It may be the sort of the catalyst for a period of profit taking in the overall market. The euro is in an upward trend, and this is an important chart for the market because the market tends to correlate with the euro. Now the euro has been pulling back for 5 or 6 days, but it remains in that upward trend. So again, if we break that upward trend line in green, just as if we break the downward trend line on the US dollar, well, then we might see a catalyst for some profit taking in the stock market. Gold remains in a downward trend. I thought it might try to break that downward trend. It certainly was flirting with it late last week, but today it really broke down in a big way, and that tells me that this market remains bearish and something I want to avoid for now. Oil is taking a little bit of a break after a 2-month rally. It's not made it up to resistance yet. I think it will make it up there. And so I think after this little pause, we could see the oil sector start to move up again toward 24 on the oil ETF, OIL. So I am bullish on stocks, but with a certain amount of caution, simply because we've been going up for over 3 months. We're nearing some areas of resistance, and it just feels like the buyers aren't all that enthusiastic. You know, I trade the market every day, and you certainly sense that there's not a lot of enthusiasm among the buyers. Bearish, I remain bearish on gold, and oil neutral. I think it's pausing here, but ultimately should start to move higher again. The stock market indexes are in upward trends, but coming into resistance and far from areas of support. They are far from their foundations. There are signs that the buyers are losing their motivation, so a pullback in the short term is possible. Gold remains in a bearish trend while oil is fighting against profit takers. Well, that has been the Stockscores Market Minutes for February 11th, 2013. A reminder to subscribe to my free weekly newsletter at the address you see on screen, and also subscribe to the Stockscores.com YouTube channel so that you can get instant updates anytime a new video has been uploaded. Have a great week in the market and trade well.